The average true range, ATR, is one of the technical indicators that measure the market volatility. It's different from the standard deviation or other volatility indicators that only consider the closes in a given period. Therefore, it's particularly useful for some unique purposes, such as setting thresholds for stop losses or entry triggers. We'll try to break it down and explain the concept in depth in this video, so we can appreciate how to use it properly. The idea of the average true range indicator is actually pretty straightforward, but for a proper understanding, we need to break it down to all the three words, backwards, from range to true, then to average. The standard ATR was developed by J. Wells Wilder in 1978, which is what we will be focused on here. First, the range. The range is really just the range within the time window of interest. Usually we are looking at the intraday range from high to low. We will use the candlestick charting, which is probably the clearest way to demonstrate this. You are probably familiar with these typical candlestick bars. On the left, we have a bullish bar where the close is higher than the open. And then on the right, we have a bearish bar where the asset closes lower than the open. The range is nothing complicated, just the full span of the price movement from high to low in both cases. The word true indicates that the intraday range can be misleading, in other words, untrue, if we want to know the more fundamental or more meaningful range of the possible price movements. This is because quite often the asset that we are interested in can experience overnight jumps, leaving a gap between two consecutive days. So it's natural we should find a way to include the gap when trying to define the actual range the price has moved in the time window we are interested in. What Wilder did is simply just compute the absolute value of the difference between prior day's close and the current day's high and low in order to define the maximum full range of the price movement within the time window. We'll use front-month corn futures as an example for demonstration. It actually has the so-called rolling built in, but for demo purposes, we'll treat it like a stock. Looking at this candlestick bar, the intraday range is from high to low. Pretty simple. But to get the true range, we need to calculate the difference between prior day's close and today's high and low. In this particular case, the true range will be from prior day's close to today's low, since it's a bearish day and there's a gap. So that's the definition of true range, the maximum of 1, 2, and 3. And this definition takes into account the overnight gaps in the case of daily true range. This would be particularly useful for commodity futures that have upward and downward limits imposed by the exchanges for investor protection, along the same line as circuit breakers for equity indices. This is actually one of the major reasons why Wilder created the average true range indicator. We'll explain these concepts in another video in the future. Now, the average. The average is just the exponential moving average of the true range, commonly with a 14-day span. Some people may use simple moving average too. There's no strict rule about this, though Wilder's version uses exponential moving average, which can be defined in this recursive formula. We can get a better understanding of ATR by looking at how it's used. We will look at just one example here, which is to use ATR to define trading stop loss for the trade. Looking at the Amazon stock in this period, which is July-August 2021, we see a triple bottom pattern here, though a little weak. But for demo purposes, we are going to enter this trade, and we will enter at the close. we will need to set a trailing stop loss. This is where ATR can be very useful. We don't want the trailing stop loss to be too close to the last high. Consider the following scenario where the price drops by 1 ATR. Since that's just an average range of possible price move within the day, the chances are it's just a normal day. And you don't want to be stopped out during a normal day, but want to wait for the new trend to actually end with a higher probability. With that consideration, let's set the trailing stop loss to be 2 ATR. Remember, this is just for demo and educational purposes, as no strategy is guaranteed to work and trading comes with enormous risk. Now let's see how this trade goes. We see a possible stop exit here. The price has dropped 2 consecutive days, but we see the trailing stop loss, which is from last high. Let's extend it to present day, and we see the close just barely missed the stop, so we are not stopped out. Now we keep going, and it was a good decision to stay in the trade. Now here is another possible stop exit. Let's extend the trailing stop from last high, and we see it indeed hit the stop, so we need to exit the trade. If we look at how the price goes, this is a good decision as the stock enters a bearish period later. Of course, we have cherry-picked this particular trade for demo purposes. It could be easily a bad trade if we didn't exit in time or exited too late. You should experiment different setups and parameters and see what works best for the assets you are interested in and for your own purposes. In this video, we have introduced one of the useful volatility indicators, average true range. It takes into account the overnight jumps as opposed to just the intraday range between high and low. The standard ATR uses exponential moving average, but some people use simple moving average as well. We also look at one of the ways using ATR, which is to define a soft trading stop loss. It would avoid overtrading or premature stops. You can imagine there are other ways to use the ATR. For example, you may decide not to enter a breakout trade if the possible breakout didn't really break above certain buffer zone defined by the ATR. Okay, hope you find this useful and hope to see you next time.